The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. The Nasdaq suffers back-to-back losses of over 1% for the first time since April, with almost $1 trillion now wiped off technology, chip makers and services stocks as investors fret over the impact of AI.
Alphabet flags it could more than double its AI spending this year after the tech giant posts over $400 billion in annual revenues for the first time.
Pressure builds on the UK Prime Minister Keir Starmer as his own Labour MPs force the release of documents related to Peter Mandelson's appointment as US ambassador and links to Jeffrey Epstein.
There was a due diligence exercise and then there was security vetting by the security services. What was not known was the depth, the sheer depth and extent of the relationship.
All right, Wael Sawan over at Shell is on a mission to close the gap in valuation between Shell, the British oil major, and indeed its US peers. Just for reference on that point, it trades at roughly 12 times forward as opposed to Exxon, which trades at 20 times forward. So you can see there's a significant gap between how the European majors, it's not just Shell, are trading compared with the US as well. They can't do much about the price of oil, but what they can do is their own operational position as well. And they are giving... Corporate adjusted earnings are expected to be a net expense of around 400 to 600 million in the first quarter. That's not the key line, though. Key lines include the fact that the adjusted EBITDA, $12.8 billion US dollars versus the estimate of 13.1 billion. So that looks slightly below the IBES estimate there as well. Fourth quarter dividend, 0.372 dollars per share. They give you a 3.76% yield, and shareholder returns are such a key part of the strategy. Don't forget, going forward, they've committed to 40 to 50% of operating cash flow will go to shareholders. And as part of that, of course, renewed buybacks. And they've announced a $3.5 billion share buyback program. So they will continue with that as well. Adjusted EPS, 0.57 versus 0.63 expected. So these look a slightly light set of numbers as well. Again, the underlying oil price being a contributory factor. I'm just going to look at one or two more figures. Adjusted earnings, 3.256 billion. Estimate 3.5. So they look light, but we're going to get an opportunity to speak to Wael Sawan about how he is replenishing their oil and gas reserves and what they have still as a renewable strategy and where they go next to find that growth in barrels, because they will see a depletion of current production if they don't renew it somehow over the next few years. But fascinating set of numbers and a fascinating company.
We've got to get up to speed on the markets now too, because if you take a look at the difference between the Dow performance and the Nasdaq performance, you can see that the tech rout was still playing out in session yesterday. So you had gains on the Dow, but that sell-off not just in the software companies again, but other areas of some of the reporting stocks in the tech universe. That was where you saw fairly steep declines, the likes of AMD, for instance. In terms of the tech sell-off, this is what it looked like. Palantir, we mentioned earlier in the week that it got its earnings away cleanly. In fact, the stock actually bounced on the back of earnings from the company that is one of the highest valued stocks in the sector. But it too has been caught up in the selling that has really been the trigger this time around, the software concerns. Palantir down double digits, 11%. Oracle, CrowdStrike, Meta Platforms, and again, Meta, one of the standout performers this earnings season. It too faced some selling pressure yesterday. So it felt as though the software selling extended out to other areas of technology yesterday. AMD, the market thought that there'd be better guidance here. The stock down heavily, 17%. Nvidia, Broadcom, Micron, all reversing in session. So again, the software selling really just taking hold of some of the chip sector stocks that many thought would be immune as well. When it comes to AMD, Advanced Micro Devices was among the worst performers on the Nasdaq, with its worst session since 2017. CEO Lisa Su defended the company's lackluster forecast in an interview with our US colleagues.
When I say that we're seeing an acceleration, I would say in the last 60 to 90 days, we have actually seen an acceleration, particularly when we think about 2026. And, that comes in terms of, demand patterns, forecasts, and just the general feeling like there's not enough compute out there for everything that wants to be done. And you've heard that from a number of our top customers, but I can say that we see that on the inside. There's a desire to ramp compute more quickly.
Well, we saw one big number from Alphabet yesterday. That was on the capex side. The stock has been volatile in after-hours trade. Now, Alphabet beat on the top and bottom lines in the fourth quarter, posting revenue of almost $114 billion, while net income rose nearly 30% to $34.5 billion. The Google parent company said it could double its capex this year to as much as $185 billion. Remember, that figure will be repeated over and over again. $185 billion at the top end, as it continues to bet on huge demand for its AI products. The tech giant posted annual revenues of over $400 billion for the first time in 2025. On the earnings call, CEO Sundar Pichai revealed that the Gemini app has now over 750 million monthly active users.
We definitely saw, I would say, extraordinary period of growth in Q4 for Gemini app. It's not just a growth in monthly active users, but there is definitely, there was a sharp increase in engagement per user on the app. So all the metrics, be it active usage, the intensity of usage, retention, all showed distinct progress across iOS, web, Android, etc., and geographically globally.
Let's get to Arjun for more. Arjun, some are describing that capex figure as sticker shock, but the reality in the weeds of some of the numbers yesterday, the fact you had 750 million monthly active users on Gemini already, so marching towards OpenAI, and the cloud number is very strong.
Yeah, look, I think what Alphabet was doing here was really testing its favor with Wall Street at this point, putting out what is one of the biggest capex figures amongst its hyperscaler peers, if not the biggest. And clearly they were able to back that up because what they saw was those AI products in the last quarter were very strong. You mentioned the Gemini user figures, 750 million users. That was 650 million the previous quarter. Another 100 million users so quickly as well. The cloud computing division as well, growing at 48%, again faster than some of its peers with a backlog, they were saying up 55% on the quarter. So there is huge demand there, and so that capex is trying to spend on buying chips, increasing compute capacity, and this is really key. Now, what this has set up really, I think, for Alphabet going forward now is extremely high expectations that they'll need to justify when it comes to growth around their AI products going forward. Because I think, as we've seen with Microsoft, they were spending a lot of money, but when those figures didn't quite hit market expectations, there was a fall on the stock. And so Alphabet's very much set up high expectations for the rest of the year, particularly on those AI products.
Okay. We're going to move on to a little bit of sound, I believe.
Well, it was only, I wanted to just sort of highlight a little bit about Gemini and how important that is to the company and where DeepMind plays a role here, because that big spending coming in from Google is going towards DeepMind. And when I spoke to Demis Hassabis just a few weeks ago, he explained how quickly Google and DeepMind are iterating on the product. Let's just listen in.
The last 3 years, we've combined everything together into Google DeepMind, this one entity that all the AI research at Google goes on in, and it's a kind of combination of Google Research, Google Brain, and DeepMind. And I run that group, and it's like the engine room of Google. You should think of it like that. So all the AI technologies is done by this group, by our group, and then it's diffused across all of these incredible products right across Google. And the last couple of years, we've been building that backbone. So not just the models, but also almost re-architecting the entire infrastructure of Google so that it can, these things can ship incredibly quickly. These models, it's almost sim ship to all the main surfaces. So, when we release a new Gemini model, it's there the next day or the same day in search. And that's been going really well. I would say we really got into our groove with the 2.5 Gemini models. channels, and for the last sort of year, that's becoming really a smooth process now, and I think you'll see that more over the next 12 months. And so, we think of ourselves as and describe ourselves sort of as the engine room for that. And, Sundar and I pretty much talk every day about strategic things and where should the technology go and what does the wider Google need. And then, we adjust the roadmaps and the plans, on a daily basis, whilst keeping in mind the long-term goals of, getting to AGI first, fast and safely.
That was the Google DeepMind CEO talking about how often he speaks to Sundar Pichai and how quickly they're iterating on the product for the Gemini models that goes into Gemini product. I think that underscores why we're seeing this huge growth around Gemini, and it does set up future growth expectations.
Are you joining us later on?
I am.
Because isn't it amazing how we got to move on, but Gemini and Anthropic, you guys the experts, seem to have the buzz at the moment, whereas XAI and dare I say OpenAI, not looking as good at the moment. Maybe it's just the headlines I'm looking at, but I'd love to know what you both think about that next time round. Right, let's have a quick look at Maersk. They reported fourth quarter operating profit broad in line with expectations, but have warned about freight rates compounded by ongoing industry challenges and that would weigh on 2026. I want to know what the CEO says, and there's only one person who's going to tell us, and that's Charlotte, who's speaking to Vincent Clerc.
Indeed, thank you, Steve. We're going to dive straight in, speaking to Vincent Clerc, the CEO of Maersk. Thank you so much for joining us. The numbers have just hit the wires. Q4 revenue better than expected at 13.3 billion. EBITDA, the top end of the guidance that you had given. So looking back at 25, of course, still a lot of disruption. How has the business looked, particularly in Q4? Are we starting to see a sort of normalization?
I think, as you rightfully say, lots of disruption in 2025, but also a lot of resilience in the global economy and especially on consumer demand across the globe. And that's what has been quite supportive for all of our businesses in terms of volumes. Now, 2026 looks a lot more like a normalization year. We've had a downward trends with respect to prices in our shipping division. So while we look forward to seeing a continuous strengthening of our margins in our terminal division and our logistics division and in of our operations in general, I think the normalization of the shipping markets and the return through Suez that is likely to occur here in 2026 will put some temporary pressure on earnings from the shipping division.
And of course, the paradox here is that normalization is necessarily good news for a company like yours. And your new guidance for EBITDA is between 4.5 and 7 billion from 9.5 that you had in 25. So things are going to look much tougher for you.
I think shipping is really driving the adjustment. The rest of the business actually is going from stronger to stronger. But it's true that in the shipping business, where we've had a period now where these disruptions have been created quite favorable pricing environment, the normalization means that the cyclicality of the business is going to play, and we're likely to face some leaner times for a while until the next upcycle. But that's something we've tried before, that we're prepared for, and I think the strength of the operation is really what we can rely on to get through it.
And a very significant moment that would prove that normalization is the return of traffic through the Red Sea that you just mentioned, going through the Suez Canal again. So you did a couple of trial runs. You see we start traffic back through that route again. What's the pace that you're looking at the moment?
Yeah, so I think we're trying to do this in a gradual manner because from an operational perspective, it's quite a significant redeployment. And the other thing is that we have limited escort capacity. All of these transits through the Bab el-Mandeb will be done with military escorts for the safety of our crew and of our assets. So we're going gradually there and planning with something where the first two services have been announced in terms of dates for when we start. The next two have been already singled out and we're following close order. And then as we see this progress and we stay close to the situation on the ground, we can look at then how the rest of the network will also go through the normal sailing routes.
Yeah, because of course the ceasefire in Gaza seems to be holding the Houthi rebels in Yemen, holding attacks for now, but there's still tension and uncertainty around the situation in Iran. So that all this you keep an eye very closely on.
Yes, I think it's really good to see that we seem to be moving towards a new phase on the peace process around Gaza and towards reconstruction. That is clearly lowering the temperature and giving us the possibility to move forward with the decisions that we have made so far. But as you rightfully mentioned, there is a situation that is playing out right now with Iran, which will have or might have at some point some interdependencies with the situation in the Bab el-Mandeb. So it's something that we will continue to follow very closely.
When it comes to trade, of course, we have to talk about Trump tariffs, the ups and downs, they're on and off. How are you adapting to this kind of reshaping of trade relations globally? You know, a lot of countries, whether it's the US or others, are rethinking the supply chain, the phenomenon of reshoring. So how is that impacting your business long term?
So I think for the time being, the resilience of demand and the fact that we're running a global network of ships that is highly adaptable to the shifts that there is in terms of sourcing or in terms of quantities has been a phenomenal asset for us and has yielded the good results that we present for this year. I think we need to really realize that the supply chain that is reshaping right now has been shaped by 20 years of globalization and is the result of a long-term and with significant infrastructure in terms of where the manufacturing are, where the capabilities are in terms of also know-how and so on. As this is going to rewire, we're going to see a gradual shift. So we expect something also to take quite a few years to have a real impact on the ground.
And so you're kind of reshaping your business as well with a greater focus onto logistics, and your new CFO has a background in logistics as well. So can you just tell us more on how much investment and how much transformation of your business are you doing to push on that front?
Yeah, I think that the trend that we're seeing in the market towards a reshaping of the global supply chain for us is really underlines the importance for our business model to be able not to just do shipping but actually to participate actively with our customers in reshaping this and seizing all the opportunities that will come undoubtedly from it. We have made some investments so far, have built some capabilities. I think we need to do more. To increase the reach that we have into our customer supply chain and the impact that we can have. Hence some of the changes that we're making, including this new CFO joining the team.
You announced this morning that you're cutting some jobs, corporate positions, 15%, so that's about 1,000 jobs. So can you explain the thinking behind this decision? And is there an element of AI playing into this as well?
So we have as a regular part of ongoing business, a big focus on productivity, and this is where actually AI is playing. This is something that happens gradually as we run the business. What we have done here as we head towards leaner time, as you can see also in our guidance, is the need to review also some of the more corporate roles and to see whether we can actually head into those leaner time with also a leaner organization and a lower cost base. And that is really the framework for the current revision.
In the reshaping of trade relations, I want to ask you about China and India. Of course, India, who had the mother of all deals, which was signed with Europe, and how much China is redirecting its trade away from the US back towards Europe. Do you see a rebalancing coming particularly from these two countries?
I think what we have seen is that this global supply chain has a capacity that is actually fairly highly utilized. So when the US shifts out of China, they actually take a larger share of the existing capacity outside China, whether it is in Vietnam, in India, or elsewhere. But that capacity that is now free in China, it just picks up a lot of the customers that were previously producing elsewhere. And so what we have seen is a heightened dependency of virtually every country in the world to Chinese export at the time where the US's dependency is slowly decreasing, because it's a bit of a zero-sum game on how this is being redistributed. I think in the long run, the reshaping of the global supply chain will mean increase of capacity outside of China, so that you can gradually see that the share rebalances rather than you just have a dancing chair where people move around, but where the sum of the parts remain the same.
And yet there are still concerns that there is overcapacity in the shipping industry, especially when we've seen all the vessels not being retired. So can you speak to that concern in particular?
I think after the COVID period, where we have had extraordinary profit, we have seen a significant part of that profit being reinvested in new tonnage, which, as we need to head also towards a decarbonization of the industry, does make sense to a certain extent, but the capacity right now is coming in ahead of demand, and this is putting in place an environment where more pressure will be seen on prices probably for the year or two to come.
Vincent Clerc, CEO of Maersk, thank you so much for your time this morning. And with this, guys, I'll send it back over to you in London.
OK. Charlotte, thanks very much for that. Coming up on the show, pressure builds on the UK Prime Minister Keir Starmer as his own party forces the release of documents related to Peter Mandelson. We'll discuss. Plus, the shine comes off Pandora, with US-listed shares slumping after the jeweller warned of a potential decline in organic revenue. We will be joined by the CEO. And we'll also be joined by the CEO of Shell to discuss the oil major's fourth quarter earnings. All of that coming up here.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Okay, fourth quarter adjusted earnings at Shell slightly missed expectations, coming in at just over $3.26 billion. The British oil major announced a $3.5 billion share buyback program. So the remuneration for shareholders remaining pretty consistent as well. Let's get to Wael Sawan, who is the CEO of Shell. Wael, is it the macro or is it individual Shell factors which account for that slight miss? Our dear friend Mr. Blass says it's the chemicals business and weak oil trading, but I know the macro has been very difficult as well.
Thanks, Steve. I'd start off by saying it was actually a very strong operational quarter for us. A few things hurt us this quarter. Number one was some tax adjustments, which went against us. Chemicals has indeed been weak, but I would look to the strength, actually, of our integrated gas, upstream and marketing businesses. This year, when I look at the holistic year, we've had an $18.5 billion adjusted earnings. We have been able to unlock some $43 billion of cash. And as you rightly pointed out, the distributions continue to be strong. We've added 4% to our dividend this quarter. We announced that, and another $3.5 billion, making this the 17th quarter in a row where we have buybacks of over $3 billion. So by and large, a very good year and really proud of how the team's performed.
There's a lot about your future strategy, I know, Wael, but you've had this 10-quarter sprint now, which you've talked previously about, and that's done now. That's in the rearview mirror. Tell me about the next 10-quarter sprint.
Yeah, I'd start, Steve, by saying, actually, coming into the job some 3 years ago, my mental model was we need to be able to become the best performing, best returning company. So you talked about the first phase, what I'd call phase one of that, the sprint. That was all about just really driving the performance culture in the company. Today, we've announced that we've taken out over $5 billion of structural costs from the system. We've really shown capital discipline, bringing down the average spend per year from 24 to 21 billion. And we've really high-graded the portfolio. Now, as I look ahead, we still see a lot of opportunities to be able to actually improve our performance through AI deployment and the way we're harmonizing our ERP systems, our IT systems across the company, the way we are unlocking more value from the supply chain. But there's also opportunities to actually enhance the returns. And I would say this next phase, you will see us looking to continue to be consistent in our return on capital, a return of capital, I mean, and you will see us continue to drive an improvement in the return on capital. And what I mean by that is we have significant capital that's not delivering the sort of returns we expect. Watch out for us to continue to actually look at churning that capital and unlocking more value from it. So excited by the opportunities towards achieving that ambition we've set of becoming the leading integrated company, leading integrated energy company.
So look, I've had the privilege of sitting down with you and Sinead and talking about a whole host of issues looking backwards and going forward. I know what you don't want to do in terms of M&A, but surely now's the time for Sinead to say, well, I think we've got enough money for you to go out and buy some asset. The oil price is low historically as well. You've got a bit of an issue with your ONG production going out to 2040, and there will be a depletion, according to Woodmac, of like 50% plus if you don't replenish those reserves as well. I hear what you're saying about remuneration, and I hear what you're saying about cost cutting as well, but you need to go out and spend some money to build up production, don't you?
So last year we spent $2 billion buying some assets. That's added around 40,000 barrels per day worth of new production for 2030. And actually, just a few months ago, when we showed the trajectory of our oil and gas production, we had a bit of a gap to keeping our liquids flat by 2030. We have now largely filled that gap just through doing better with our existing reservoirs. But to your point, Steve, as we look ahead into the future, of course, we're always looking at opportunities. But the beautiful thing about it is, for the next 5 years, we're not in a rush. cash, we have the space and the time to make sure that any investments we make in M&A are value accretive for our shareholders. And so for us, it's making sure that we allocate capital in the best way possible and creating the space and the time to be able to make sure we have that flexibility.
Well, as we talk about those dynamics, let me ask you about the backdrop closer to home, because the US president put the spotlight on the UK energy policy when he was in Davos, again taking aim at the windfall taxes, even though we've seen a massive decline in the oil price, the ban on further licenses and exploration in the North Sea. What do you make of the windfall taxes? Is there any sense that this could be negotiated lower? And what do you see in terms of energy policy when it comes to North Sea exploration?
Well, I'd start by saying that if there's one thing that's coming more and more into the fore, it is that energy strategy has to be at the heart of any set of national strategies, whether it's a technology, AI strategy, whether it's an economic strategy, an industrial strategy, or for that matter, a military strategy. And therefore, it is absolutely critical to focus on those energy strategies. I think the UK continues to have significant appetite for energy consumption. To be able to achieve its multiple different ambitions. And I do think oil and gas continue to have an important role in the overall UK energy system. Now, the choice being made is to import that versus to produce some of that domestically, which I think is a missed opportunity. That, by the way, does not take away from the very good policies that the UK has, which is to invest in renewables. But it's the balance, and it's making sure that you attract capital to be able to unlock more. We have had significant capital that had been allocated to UK North Sea, which we have now pulled back because it's no longer attractive enough to make those investments. And that capital has gone into other basins where we can see return on the capital that we are deploying.
Well, it's Ben here. Good to speak to you. In terms of the developments we've seen geopolitically around Venezuela, do you see it more as an opportunity there with the potential for getting US licenses to operate there, or do you see it more as a threat, the extra supply potentially depressing the oil price?
I'd start off with the broader picture there, Ben, to say that the world needs more oil. We're growing at 1 million barrel per day demand at the moment, consistently. And natural declines on existing fields are around 5 million barrels per day. So we're having to replenish around 6% of global production every single year. Venezuela just makes up 1% of current production. So we need that oil to be able to make sure we can match the demand. From a Shell perspective, Venezuela is an opportunity. We have a long history in Venezuela. We actually discovered the first oil in Venezuela a long time ago now. And as we think about the future opportunities, we're particularly focused on gas, in particular offshore gas, I would say, where we had been working under OFAC licenses to be able to develop some of those options to tie back some of that gas to Trinidad and Tobago, where we have an existing LNG facility. So those are, I'd say, the first set of opportunities we're looking at. And of course, keeping our eyes open to what other opportunities may emerge. But that will require the right overall context for the investment to take place.
Final question, Wael. It's very clear, and we know from your strategy the last couple of years, the pivot away from renewables focus as well. But by the time you finish selling off renewables assets, what is going to be your renewable portfolio?
We are very focused on two key elements on the low carbon space. One, indeed, is not in the renewable generation, but much more in actually the flex assets. And what I mean by that is battery, gas-fired power, and linking that into our trading strategy. That is where our strength is. The second part of that is low carbon molecules. We are very much invested in areas like green hydrogen at the moment. We're looking at what we can do to be able to continue to develop our world-leading CCS portfolio, carbon capture and sequestration. This past year, we had taken a final investment decision on the second phase of one of the largest CCS projects in Europe, out in Norway. So that is much more the focus, along with biofuels and some of those elements. So it's much more of a, call it molecular focus, more so than an electron-based focus. And that is where we think we can particularly differentiate ourselves, Steve.